Are you a podcaster? Maybe you've got that big idea and you're looking for a network to join. The multi-award-winning Ozcast Network can get your content to eyes and ears all over the world. Join now for the first month free, and you could be featuring this sound at the beginning of your podcast.
Ozcast.
Simply head to ozcastnetwork.com for details.
Ozcast.
Paul Atherton is an ex-Wall Street advisor on a mission to help young people win back their financial power, wealth and security. He does this by helping them understand the hidden world of finance, risk and investments, helps them figure out how it impacts them, and to seize the opportunities to make it work to their advantage. This is Paul Street Journal. I'm here this morning with Paul Atherton. How are you, Paul?
I'm well, Tim.
That's good to hear. Now, something maybe not so good is I know that you were in risk management during the GFC, so you would have really seen the crux of it. Could you explain it? I mean, most of us, we hear it on the news and it sounds like, a bomb went off financially, but what actually happened?
Well, I think, it was well, I describe it as Armageddon, and a lot of people describe it that way, and I think people on the inside felt, definitely, I not only felt it, it was genuine, it was real. And it impacted let's call it from the Wall Street and the financiers' economy to the real economy. It impacted the United States real economy, and then to a lesser extent, Europe, and then other parts of the globe. And I think areas that have perhaps steered clear of the results of the GFC have not really understood or really delved into what caused it, and are we out of it, and what perhaps the ramifications are. So maybe we'll just dive a little bit deeper into that. So if you go back to one of the big primary candidates for the cause of the GFC is what they call the subprime mortgage industry. So if you go back into early 2000s, the subprime industry took up, maybe 4 or 5%, maybe it was 3%, can't quite remember, of the mortgage market in the United States. So unlike in Australia, when a mortgage is done, a mortgage, you do it with the bank and the bank holds it on its balance sheet. And the balance sheet is fine because the mortgage is what they call variable rates, and it varies with interest rates, so it's not a big issue. The risk is really transferred back from the bank back to you as the consumer. So the bank's only risk is that it gives a loan to a poor quality and a poor risk on you as an individual. But in the United States, it's different. All loans pretty much are fixed. So that transfers the risk back massively to the bank, because if interest rates vary in the wrong direction, you're fixed. That could be very good for you. So if you've held it, you got the interest rate at a very low rate and they start rising, it's almost like you're making money as an individual, but the bank is losing money. That's very bad for the bank. So along comes Wall Street and says, you know what, you don't want that on your balance sheet. We'll take it. And well, because it's fixed, we can tranche it up, particularly because it's fixed. It just makes it easier. And then you can tranche it up, pull it together, get 1,000 mortgages, say, and work it into various payable tranches that you then rate AAA or triple B or triple C or whatever. So you can rate it, and then you can sell it off to investors who get a higher yield. And this type of thing really took off in the 2000s. I think particularly post the dot-com crash. Now, what not everyone understands is the dot-com crash caused, at least initially, more financial loss than the GFC. I think the dot-com crash lost about $9 billion, wiped off the value of various stocks and investments. Whereas the GFC, I think, was in roughly 6 to 7 trillion range, still pretty huge. So at least initially, one could argue that we're still in the GFC, so the costs may be still there. But point is, we didn't feel the ramifications of the dot-com cascading because the GFC was a different type of crisis, and B, Greenspan, who was the Fed chairman at the time, lowered rates massively, I think from 6 to 1%. Well, because we had the dot-com, then quite closely followed by 9/11. And so we went from roughly 6% interest rates to 1%. So now we're in a state of significant liquidity, which means a lot of money running around the system. Because if you think about it, most of the Western world is what I call long credit. They have mortgages, they have personal loans, they have debt. And most of that debt, particularly mortgages, are subject to interest rate variables. You lower interest rates, guess what? You have a much freer amount of cash. You go and spend that and it releases itself into the economy. So lower interest rates in a Western context will result in more money into the economy. At the same time, we had the George Bush government. We had massive tax breaks. We had the war in Afghanistan and Iraq and other spending, which I think just in the Clinton era, they were projecting surpluses. By the time George Bush was done, we were in massive deficits, fiscal deficits, I should be clear. And then again, a fiscal deficit is a fiscal government deficit is a private surplus, meaning there's excess money into the system. Not always a bad thing. But if you align that with lots of low interest rates, now we've got excess deficit spending, and now we've got the risk appetite of Wall Street trying to chase yield, because with low interest rates, you get lower returns, but people want to get higher returns. And Wall Street came up with these new instruments, which weren't so new, mortgage-backed securities and then collateral debt obligations, and then made some other funky ones like credit default swaps and so on. So these started getting rather large. And by, I think, 2004, the rate of subprime, so subprime comes in. As I said, subprime lending was around 3 to 5% of the economy of mortgages in early 2000s. By 2004, 2005, it's about 20% of mortgages are in the subprime. And the size of the mortgage market was about the same size of the global economy, which is about 60 trillion.
Jesus.
In other words,
in the US specifically?
Yeah, in the United States. So, well, and then European banks piled in. They were buying up all of these tranches and mortgage-backed securities. They were getting into the game. So we had a lot of cross-border flows of cash from New York to London, from the United States to Europe. And all these institutions became incredibly intertwined with each other. And then finally, of course, we got the time where Greenspan was raising interest rates from 1 back to 6. The political atmosphere had changed. There wasn't so much, people weren't so happy with the war, and so deficit spending probably wasn't where it was. Bang, there we go. That broke, somewhere along the line, broke the subprime back. And then they started worrying about what was on people's balance sheet. Now, if I think about the GFC, I tell people it was like a bank run on banks by banks. So debt in on itself doesn't cause a crisis. A bad balance sheet causes a crisis. Now, that doesn't always win me friends with economists, but that's just reality because, debt's back to kind of where it was. It's worse in Australia than where it was. But what causes a real run on banks, or what causes a crisis or a financial crisis tends to be, is a bad balance sheet. And what all the banks had were, very questionable assets because they were tied up in these mortgage-backed securities and CDOs. And where were they? And were they appropriately hedged? We didn't know. When we know, we couldn't answer for our own banks. So what could we trust other banks? And these mortgages-backed securities were also in the same companies, these money market funds, that were also owned because they were sold by Wall Street, the same funds that were funding the liability side of the balance sheet of investment banks. And the liability side was funded very short term. And so as the redemption started coming in to the money market funds in particular, they started redeeming from Wall Street, from the banks, and then there was an asset liability mismatch, effectively being insolvent. So that's it, a bank run on banks. And I remember being in a boardroom and we had a war room, perhaps was the better word for it. We put up on the board which banks we could trade with, who we could and who we couldn't. Most of the places we couldn't trade with. The ones we could were other investment banks where we placed significant monies of cash. We only traded the cash we placed in their account. So it was pretend trading until we got our balance sheet shored up. And then to the Fed, of course, to save the day.
And do you think that was actually saving the day?
Oh, 100%.
Okay. Yeah. It was necessary.
It was Yeah. Well, some argue that they caused it, so they might as well solve it because they should have bailed out Lehman in the first place.
Yes.
But the political appetite wasn't there. And it was pretty much not even there. I don't know if people remember this, but it wasn't overly there even during the GFC. So they backstopped $800 billion to back essentially the money market funds, or really the liability side. They said the money was there. It's a nice way of saying we'll fund whatever. So the funding was there. What people don't realize is the political will being there. So the $800 billion was asked for, but it had to be agreed by Congress, and they disagreed. They didn't allow it to pass.
Keep blocking it. Right.
So I think, if memory serves me right, the largest drop in the stock market wasn't during the GFC in September. It was in October when Congress said no to funding.
Wow.
TARP, the $800 billion. That was the biggest drop, and then it passed post that because every member of Congress got a call because it affected the real economy.
Wow, far out.
So that's the way it played out. So the political economy was significant. Interesting. Also, I think there was a lot of talk from Europe saying it was an American problem, whereas actually it was very much a European problem as well. And if you looked at the Fed minutes during these meetings, I think the second point on the agenda, maybe even first, correct, I don't know, I have to go back, was what we do about European banks. And over a very short period of time, European banks were funded, the central banks were funded by the New York Fed for dollars, because that's what they needed, up to the tune of about $2.5 trillion.
Whoa. So
there you go. So there's a group of an institution that say they survived the GFC and it was an American problem, needing $2.5 trillion of American money backed directly by the Fed. Australia has the same thing, by the way. We drew on about, I'm guessing about 150 billion. So we had the same problem. And the credit line is still there, ladies and gentlemen.
Really?
The line is still there. So it's one of those secrets that are not secret. It's out in the open, but not spoken about.
Yes.
Or not known.
Yes. And I personally believe a good film on this, if most of that just went over your head, ladies and gentlemen, The Big Short, I believe, does quite a good job of explaining.
Do you know, I've never watched it.
Really?
I tend to steer away from those movies because I find them to be fake and just to be wrong. And I've been told again and again by people that I trust and I respect that is in fact a good film. The book was written by Michael Lewis, who was a very good writer and an ex-Wall Street analyst, or he was on Wall Street, but has written some brilliant books. So I'm not surprised that it's quite accurate.
Yeah, so maybe at least as a basis, perhaps, if all of that just went over your head, it would be a good basis to start with, and maybe you can learn some truths that are perhaps wrong in the film later on.
Yes, and I knew a lot of the players too.
That's crazy. Yeah. All right, thank you for that, Paul.
Lovely.
Paul Street Journal.
Ozcast. Are you a podcaster? Maybe you've got that big idea and you're looking for a network to join. The multi-award-winning Ozcast network can get your content to eyes and ears all over the world. Join now for the first month free, and you could be featuring this sound at the beginning of your podcast. Ozcast. Simply head to ozcastnetwork.com for details.